Hello and welcome to RVA Wealth Management's first quarter market update. First quarter of 2024. We have made it to 2024, Mike. Can you believe it?
No, that was quite a year last year.
Yes, it was. Quite a ride, if you will, up and down. So very exciting year. And following 2022, much better. Versus when we think about what happened with the markets. But at any rate, we're going to talk a little bit today about that. We'll talk about where we are now because we've moved and give you some updates on what we think we're seeing in the markets here in this first quarter. So we have moved. This is a visual looking back at our office. We're on the second floor in 4510 Cox Road. So you can sort of see the actual second floor office suite right there. And this is the front of the building. So when you come to see us next time, you'll be coming in. The guest parking's there to the left-hand side. And so there's plenty of guest parking places out there. And we look forward to seeing you in our new location. And there it is. We're not far from the old location. So if you do happen to go to the old locations, because, you got it already programmed, and that's where you're going. We've already had some people do that, so we know it can happen. Don't worry, we're a few minutes away, about 5 minutes from the old location. So you just hop in the car and run on down if you realize, oops, not in this place anymore. Looking forward to seeing you at the new location. So let's talk a little bit about 2023. So the S&P 500 index staged a very strong comeback, really, in 2023 after a 20% loss plus in 2022. It was one of the worst years we've seen in the market in a long time. So 2023 closed out the year near its all-time highs. And in fact, I think now this is January 22nd? We've actually had a new market high hit again already. So really, really nice move with the market last year. The Magnificent Seven, which are your large cap growth stocks, really were the ones that staged the major rally, handily outperforming the S&P index for the year. So your Magnificent Seven, in case you don't know, is Google, Amazon, Apple, Meta or Facebook, Microsoft, NVIDIA, and Tesla. NVIDIA really led the way on the heels of some really major developments in AI technology, including large language models such as ChatGPT, which came about. You sort of saw that in the first quarter of 2023. And the market was very excited about the potential that AI has to improve workplace productivity and really take us to places we've not been before. In addition to that, the pause, we call it the pause, by the Federal Reserve in the summer of 2023, along with continued cooling of inflation, really helped to extend the rally that eventually did carry over to bonds and the broader stock market in the fourth quarter. Really up to that point of the year, it had just been really those large cap growth stocks that had taken off. After that, we did see a broader rally across the entire market. So I'm going to let Mike talk a little bit about some of the annual returns and intra-year declines that we saw. Mike, if you want to jump on this slide, that'd be great.
Yeah, so looking at the point of this is you can have big volatility every year and be down drastically every year and still end up with a really decent return. So at one point last year, looking at the far right-hand side of the slide, we were down on the S&P 10%, which is very normal to have a 10% drawdown on the S&P 500, and yet the S&P finished positive for the year for 24%. Looking at probably another extreme example was obviously during COVID, 2020, dramatic sell-off over about a month or so, and the market was down about 34% at one point and staged a remarkable comeback and ended up having a very strong year in the stock market. So I think the point of the slide is to really stay invested for the long term. It's very easy to panic during these drawdowns, but 10% plus, it's very common. As you can see, just about every year we have some sort of pullback.
So volatility is here to stay. And we do think that because the stocks are starting the year at a premium price, really, given their earnings projections. And also due to some sketchy equity valuations, restrictive Fed policy, and the signs of a slowing economy, not to mention what's going on overseas, we would not be surprised if 2024 turns out to be a very volatile year for stocks. But we also have a very resilient U.S. jobs market. We have the impact of AI, which I mentioned earlier. And there's a lot of other innovations that could help drive this market higher by the end of the year, possibly to new all-time highs. And we've actually hit an all-time high with the S&P just recently. Will it finish the year at all-time highs? I'm not sure. It really depends on whether or not we get a recession. If the U.S. economy can avoid a recession, then we may end the year at new all-time highs. I do think, though, by the end of the year, we will see a market that is up slightly. Again, that does depend on if we get a recession and how deep it is. So, Mike, let's talk about some of these inflection points that we see with the S&P 500 index over time.
Yeah, the January 16th, the market was right around record highs, 47.66. In the last week or so, we have touched new highs here. It's really important to look at the valuations, though. The forward price to earnings multiple, 19.5 on the S&P. Historically, that's a little rich. You can see when the market sort of bottomed out in 2020 in October, the S&P's forward price earnings multiple was 15.7. Coming into the end of 2022, it was 21.4. The beginning of 2022 was 21.4, and then we saw a pretty sharp sell-off. So these are pretty rich levels right here, but I wanted to point out the largest stocks are really dragging up the multiple, and there are a lot of reasonably valued stocks out there if you look underneath the hood here.
Absolutely.
We always want to track earnings. It's obviously very important. The last year, we had pretty good revenue on the S&P's earnings, but margins started to come in a little bit after hitting record highs. And you can see on the right-hand side, profit margins hitting that high over the last few years. Since then, they've come in. They're still really good, but can companies continue to defend these margins? They've had increased labor costs for the last few years, increased input costs. It's going to be very important for them to defend margins here. Back to the left-hand slide, what's the outlook for the next couple of years? It's pretty optimistic. What analysts are looking for as far as earnings growth, a 12% increase this year, followed by a 13% increase in 2025. That might be a little bit aggressive. I think what they're going to probably need here is a really quick impact from AI to increase the productivity and be able to cut costs. But realistically, companies are going to have to sink money into AI the first few years. There's going to be a lot of infrastructure built out, and you could see the benefits in a few years. But can we expect to grow 12%, 13%? It might be asking a little bit much here.
It would be wonderful if we did, but that really is illustrating what the market expects from AI. So it's that great improvement of productivity, which if you don't understand productivity, know this: productivity will add profits, bottom line, to companies if they can realize that productivity. And when do they realize it? Like Mike said, there's a buy-in process. They have to build the infrastructure and get things ready. We don't know how long that'll take.
All right, this is a pretty fascinating slide to me. On the left-hand side, the performance over the market last year, the top 10 stocks, the ones we discussed earlier, and then we're going to add in United Health, ExxonMobil, Berkshire Hathaway, phenomenal. We're in the green. 64% appreciation in those top 10 stocks, just incredible. They have such a large weighting to the S&P 500. It's a market-weighted index. The S&P went up 24%. If you look at the remaining 490 stocks in blue at the bottom, for the most part, they were flat to slightly down most of the year until late November. Fortunately, they were able to eke out an 8% gain. So if you're in a diversified portfolio and not just loaded up on the top 10, it wasn't a very exciting year until the very end. Right. That is just a really surprising gap there.
It's unusual, very unusual to see that.
So value versus growth, we have both of those in our portfolios here. And typically, growth stocks are more expensive than value stocks. Investors are willing to pay a higher multiple for stocks they know are going to grow more rapidly. And that there's always a premium for those great growth stocks. Recently, though, what we've seen is an increase in the gap of that multiple. Currently, value stocks are trading at 14.7 times forward price to earnings multiple. That's right in line, maybe a little bit higher than the long-term average. Growth stocks are trading at significant higher levels than their long-term average. So the market really is betting on fantastic growth coming up here. Analysts are looking for the 10-year Treasury rate to drift back closer to 4%. We're currently around 4% right now. In that environment, historically, the 10-year drives a lot of investment decisions. Typically, growth in value stocks have averaged about 6% returns in a 3 to 4% 10-year Treasury. So I found that interesting. In a very low interest rate environment like we had in the last few years, it's great for growth stocks. They really outperform in very low interest rate environments. But we're probably coming into more normalized interest rates here, and historically, growth and value have performed just about the same in this environment.
Yeah, but if we see interest rates higher in that 4 to 5% or better range, then value tends to outperform growth. That's a very interesting statistic, and last year or so we actually have had a higher interest rate than that 3%. We've been in that 4% plus range, so you would expect value to do better in that environment. Now they have come down, so we'll see where they go from here.
All right, inflation's been the big story. Coming into last year, really a lot of analysts were looking for a down market and the economy to really struggle because of the rapid rise in interest rates. The economy proved very resilient. Market ended up having a great year. The Fed has been pleased, though. They see inflation coming back to their 2% target. We peaked really the middle of 2022. We were over 9%. We hadn't seen those levels since the 70s. Since then, inflation's come in hard, and the Fed recently decided they're going to pause, at least for now, and the market's starting to price in cuts this year. The biggest reason here, energy has come in rapidly, which has been a bit of a surprise with all the conflict around in the world right now. But energy is an input for most goods, and it's because of the United States being able to increase production so rapidly and become a net exporter. It's been a really deflationary, which has been great. Looking at the bond market, pretty good setup for the bond market right now, in our opinion. 2022 was a historic sell-off in bonds, with rates moving up really quickly. It was pretty much a bloodbath, especially in longer-dated bonds. So now we're coming into a pretty attractive environment here, where the yields are really attractive that we're seeing. We're getting on these bonds. Corporate bonds, it's represented there by IG Corps, which is investment-grade corporate bonds. You're getting a little over 5% yield. We weren't getting anything near that a few years ago.
No.
You're getting a 2-year U.S. Treasury over 4%. That's pretty attractive for not taking on much risk. Mm-hmm. If you go further out on the yield curve, you're not going to get paid anymore, really. It's a flat to inverted yield curve right now. So that 2-year level has attracted a lot of money. Mm-hmm. Over on the right, you can see if we do get cuts this year by the Fed, what would be the impact of a 1% rise or fall in interest rates? You can see investment corps would benefit greatly for a 1% cut. So you could look at a situation where we're getting close to 5% interest plus potential appreciation on your positions. So we've shifted a little bit more into bonds here over the last year. We think it's a pretty attractive setup after that big sell-off in 2022. And this chart will show us valuations on various fixed income markets versus their historical yields. We're getting much better yields than we were historically. So investment-grade corporate bonds right now, the 10-year medium yield was over 3%. We're getting over 5% right now. Municipal bonds, especially, that's shown for very high earners, what would be the tax-free equivalent, 5.6% yield for people in that high tax bracket, 37% tax bracket, versus 3.9% recently. And U.S. Treasuries at 4%. That's pretty attractive right now, and it's trading at a pretty reasonable valuation.
Yeah.
And looking at valuations here, after the big run-up last year we saw in growth stocks, large cap stocks, and U.S. high yield, valuations are well above where they were coming into last year. So anything with a positive number is a little bit more expensive versus historical valuations, and if a negative, it's saying it's pretty attractive valuation. So international markets, if you're willing to dip your toe in there, they're saying they're cheap right now. Treasuries are looking pretty attractive right now. They're trading at a negative number there. U.S. core bonds look to be attractive right now. It just looks to be like some of the U.S. large cap stocks have gotten a little pricey here.
And so when we talk about diversification, that's sort of what you were referring to in that previous slide, right, Mike?
Yes.
And this chart just sort of shows you all the different asset classes over time and how you never know what's going to be the best or the worst in any given year. I mean, just look at 2022. The best performer in 2022 was commodities at 16%. But in 2023, it was your worst performer at -7 or -8%. And in the middle, you can sort of see that dotted line. That's just an asset allocation portfolio, basically a 60-40 mix, the classic moderate type mix. And you can sort of see where it's fallen, and it sort of does stay right in the middle, which is a good thing. That's what you want to see when you're diversified across a lot of different asset categories, because you just don't know who the big winner is going to be. And so far this year, the big winner has been what? Cash. I mean, really. And in 2022, it was number 2. So in tough, more challenging markets, that's what you're going to see is cash be up there. In growth years like 2023, your large cap are going to be at the top of the chart. And you can see that large cap does tend to perform fairly well over time, although in 2022, it was one of your bottom performers. So you just don't know. That's why it's important to remain diversified. And the way we manage in our portfolios is, we do try to overweight certain sectors a little bit, but really we're trying to follow the market, and we're keeping things on an asset allocated basis based on the risk profile of the client where they should be.
Yeah, and I wanted to stress too, the asset allocation, it doesn't eliminate losses. You're going to have down years like 2022. This model fund was down 13.9. It was negative 5.8 in 2018. It does smooth out the ride though, because most folks are not going to be comfortable picking one asset class and experiencing a 25% drawdown in their portfolios.
Right.
So this will smooth out the ride, but over the long term, it should result in good long-term results for you.
And here's our disclosures with the JP Morgan slides that we used today. So hopefully this information will be helpful to you. If you have any questions, feel free to email us about this, and we'll do our best to get our answers back to you as soon as possible. Again, more information on the JP Morgan Asset Management Risk and Disclosure slides. And we do appreciate this. So just email us at team@rvawm.com. It's on the screen, team@rvawm.com, and we will get back to you to answer any specific questions you might have about what we see in the markets as we start 2024. Appreciate your time, and we really appreciate you taking the time out of your schedule to watch us today.